Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve. Today we want to talk about some unsettling headlines that we've been seeing this month. We're actually recording this in the middle of March, March 12th.
Yep.
And so
Yep.
we're in our second week of this, I think, where we're seeing the Iran conflict. Futures have been slipping, volatility is high. And we're looking at all of this and we're thinking it's time to talk to our clients. Really interestingly, I should say, Steve wanted to talk about this a
Yeah, I
couple
was going to
weeks
say
ago
that.
before we
Yeah.
even knew that this was going to happen. But we
Yeah.
wanted to talk about this because event risk, which is what we're experiencing right now, is a specific type of risk. And
Hmm.
it usually creates a lot of sudden, emotional, a lot of reaction. And we want to remind you that when we see this kind of thing, usually the best course of action is to recall what we actually structured when we were all calm and we sat down and we said, what is our strategy going to be? And stick to that strategy.
Right. And so I think it's important to understand, we'll go past this. You've seen our picture before. So a lot of people when they're trained to manage portfolios, and a lot of people in this profession, they think that all types of risk can be quantified mathematically. And that you can really be fooled that way because there are types of risks that can't be quantified mathematically. What I mean by that is we can look at, for example, the performance of an asset class over the last 50, 80, 100 years and say, all right, let's measure how volatile it is. Okay, but that measure, which is a statistical measure, doesn't can't really predict events that can really damage an investment and make it permanently worthless or make its value go down permanently. That can't always be quantified mathematically, and we're going to give you some pretty clear examples of that.
So today, what we're experiencing is not volatility risk.
No,
Um, and volatility risk is very different from event risk because event risk is not an indication that there are fundamentals breaking down. There's no real economic problem. It's just being caused by the headlines.
it could be a war. It could be a an earthquake in California is a type of event risk as well. We're going to cover some of them, give you some examples, but those are event risk. Look, can you predict mathematically that California is going to get hit by earthquake? Can you factor that in somehow into your portfolio? Well, not really. Can you factor into your portfolio the idea that we might have be at war with a country? Well, you can't really factor that in. So those are event risks. Okay. And so here's some examples based on four broad categories. For example, company-specific events. And we're going to talk about a couple of those a little further. But it could be fraud or scandals, earning surprises. Yeah, those a lot of times those can be you can recover from those if they make up for it. But bankruptcies, there's no recovery from that. For example, the stock will be worthless, and probably the bondholders are lucky if they get 60 cents on a dollar, if that much. Yeah, product recalls, that type of thing.
And
Also,
Steve, I was
market.
just thinking about a couple of them that you
Yeah,
actually don't talk about later.
sure.
And we talked about the Lehman Brothers and the Bear Stearns, but COVID,
Right.
Blockbuster, Enron.
Oh, right.
I
Enron's a great one.
Yeah, I where
Fraud. It was fraud
yes, yes.
on a
Um,
massive scale.
right. Microsoft's legal issues.
Right.
Exxon, the Valdez.
Right. Yep. Those are great examples actually. And so you can also have market-wide events and also geopolitical, which we're experiencing now, right at the top, war. And also natural disasters I mentioned. Regime change is another one. Venezuela was one of the wealthiest countries 20, 30 years ago. They have more oil than Saudi Arabia, which is actually quite surprising. But gradually, because of their political system, they turned into a socialist slash communist country, and their economy was pretty much destroyed. So that's another example. By the way, that's why I particularly don't care for emerging markets funds. We'll talk about that later. And also regulatory events, regulatory policy changes as well. Environmental rules is one, for example. They tried to force a lot of power plants out of operation through environmental rules, which general led to increase in electric prices, for example. So these are all different types of event risk, and almost none of these can be quantified mathematically. You can't really build these into models. That's the issue. So this is the oil shock.
And we're seeing volatility that's as high as 30, which is
Yeah.
considered significantly high. Um,
Yep.
and so what that tells us also is that there's a lot of movement happening in the market where
Yep.
people are going in and out and reacting. And it's our job, all of our job, to stay seated and calm and not to react that way.
Yep. And so what happened with oil, even though we have enough to supply ourselves, we're not going to have a shortage. Our oil prices are still affected by global markets in terms of pricing. And so that's the effect we're seeing right now. Price, we're seeing enormous increases in price. I think it's back up to $100 a barrel.
Mm.
It went above that, well above. Was that 150? Wasn't it 150
Was
for a
it
short
that
period
high?
of time? But it dropped back down to 80. Now it's back around 100 because they're attacking oil tankers in the Strait of Hormuz. So anyway, we'll see what happens with that.
Mm. What happens in this instance is that we start seeing um, some of the correlations between asset classes getting
Yes.
somewhat tight, at least for asset classes that are somewhat correlated already.
Yep.
Fortunately, we've done a great job with your portfolios at really looking at finding assets that are truly, truly uncorrelated. And,
Right.
if you take a look at your portfolio today, you'll see that it's performing much better than if you had just been in the US market, for example. And it's
Yes.
because we went out of our way to find asset classes that would buffer against that.
Yes. And also combine them mathematically, which, we know that there's limitations to that, as we just mentioned, but to combine them mathematically as best as possible to try to minimize risk for a given level of return. So this is a good point. We mentioned some of this already, the difference between market and event risk. Event risk is sudden. It could be nonlinear. It could be a large decline in the value of something very quickly. As we mentioned, for example, company bankruptcy, and we're actually going to mention a couple of those too later. The price spikes in oil, we mentioned that, but also the behavioral response to event risk tends to compound its effects, right? People see that they may have a portfolio that's highly concentrated to one area, so they really get hit hard by it, and so what's their natural inclination to sell right away? To try to get out of it, or to write it down. That's the other inclination. See,
We
gee,
see
it's
all
okay, it'll
kinds of
recover.
people that are not necessarily clients of ours that are
Right.
are reacting very much to this overall market. And yeah, it's interesting because while a lot of we're not getting the phones are not ringing off the hooks here because I think you all are
Yeah.
watching your portfolio and saying, "Oh, I'm protected," clearly. Um, but you have to be very, very careful because the reactions don't usually play well.
No. And one interesting thing is we mentioned about the oil right now, one of our best asset classes for the year is natural resources, which is up about 25%. And those things like that are helping to reduce the downside risk in your portfolio right now because of this event. And so this is a good comparison of market risk to event risk. Market risk I mentioned is really it's volatility, really. It's constant ups and downs. But the event risk is a one-time shock. Market risk, you can recover from market risk if you're well diversified. Like we saw in '08, people that were well diversified, even in the housing crisis, their portfolio recovered. If they stuck more toward broad-based index funds and things of that nature and avoided market timing, they recovered. Event risk, no matter what you do, you may not recover unless you're well diversified. You know. And as I mentioned here, market risk is diversifiable. You can diversify away from it. Event risk is concentration driven, and we can forecast market risk to a decent extent with models. But event risk you can't forecast it. Unpredictable, you know.
Steve, when I look at this slide, I think that the biggest takeaway for our clients is that we are always thinking about all the various components of risk. So
That's a
there's
great point.
everything from how the asset classes are correlated and how they
Yep.
move together, which is one kind of risk, and then there are individual risks embedded in each of those asset classes. And so even when we talk about something like large cap domestic, we've looked at our large cap holdings, they're all up. And that's
Yep.
because we're focused on value. We're focused on companies
Yep.
that have high cash flow, not
Yep.
focused on speculative. So every single asset class, we're really peeling the onion and trying to figure out what the risk is that we can possibly prevent against. And Steve was saying, there's that fundamental market risk that you cannot get away from.
Nope.
That's why we're compensated is by taking on fundamental market risk. But even if you look at the S&P 500 over the past several years, that's not market risk. It has on
Nope.
top of it a whole chunk of technology and AI all like driving it. So
Yep.
it's actually gone away from market risk. It's taken on what they call a sector risk.
Concentration risk too.
Right, with NVIDIA and all that.
Right.
And it's moves away from market risk. And so we're always
Yep.
looking at how can we flush this risk out as much as possible in each of these individual areas.
And in some areas, we have made conscious decisions. I've mentioned this many times that we avoid emerging markets funds. In particular, if you go to Morningstar and look at the average emerging markets fund, 25 to 35% of their holdings are in China. I've always concerned with that. I'm always concerned with investing in countries that don't have stable political systems because, first of all, look, they can nationalize their industry. They did that in Venezuela, right? Venezuela, we were just talking about, was one of the wealthiest countries uh, 20, 30 years ago. But because they didn't have a stable political system and a socialist and, slash communist took over, their whole economy was pretty much destroyed. And they have more oil reserves than Saudi Arabia, which is quite stunning, by the way.
And that's when
Yep.
you identified international small cap asset
Value.
class was a
Yep.
great replacement where we're still getting that diversification effect that emerging
Right.
markets could have done, but with less of these geopolitical
There you go.
event-driven types of risks.
And while it doesn't have as low a correlation with domestic as emerging markets does, it still provides diversification.
Yeah.
And we saw that last year. Our international small cap value holdings were up. We actually were our best performing asset class last year, up significantly. And over the last 20 years, by the way, it's beaten most emerging markets funds as well, with less volatility, by the way, as well.
Last I
Uh,
looked, it was pretty high up this year too, unless it's changed.
uh,
Every day
I
is
can
a day.
It's right now, as of yesterday, it's up with ours, it's up around about 7% for the year.
Okay, 7%. The US market is down. So there you go.
As of yesterday, the US market was down almost 1%.
Yeah.
So that's providing diversification right there.
Yep.
So yeah, and also eliminates a lot of that political risk because they're mostly developed countries with
Right.
stable political systems. Uh, so. So we're not going to go over all of these, but we're happy to provide this to you. But just as Laura brought up a good point, just so you know, we understand, we look at these risks, we've identified them for each asset class, and that's the point of this. Really, the point here.
And I guess I get bothered that people just look at volatility and
Right. Me
they say
too.
or market risk and they say, okay, as long as we take care of that. Well, no, there's other risk here. Uh,
Yeah. And this all goes to the fact why we don't really care for the 60/40 portfolio. 60% in large cap stocks and 40% in for any bonds. It's not diversified enough. And that's why we use so many more asset classes. And here on the bottom is the risk level. And rather than put an actual number, we just have a ratio there. Um, and same for return, which is on the vertical part of the graph, the chart. And so, for example, you can see that private equity is one of the highest in terms of return, but also one of the highest in terms of risk. And which is interesting, which we kind of knew anyway. Municipal bonds are lowest on the return, but also lowest on risk in the long run.
right.
And by the way, the lowest on return doesn't take into account your tax bracket. So that's an important point here. by the way.
I hate to get too deep into this, but I want to point out a couple of things that are really interesting when I looked at this
Mm.
slide. Um, as you go, so you expect a line from the left-hand bottom to the right-hand top.
Yep.
For every given level of risk, you want to get a little bit more return. So that's how this works, is that in financial theory, it should be fairly straight. Um,
Yep. Yep.
However, when we look at this, one of the things pops out just that long short funds, which are a little up this line, they're still fairly low risk. And a lot of people get confused. They think that that's hedge-like and therefore it's risky. These are not risky funds that we have in our portfolios. They're
Nope.
they're specifically intended to give you that closer to stability kind of reaction than, high risk. But the
Yep.
second thing that I look at is, gee, if you were going to invest in long short funds with a risk level of 2, as it's showing here, why wouldn't you invest in reinsurance bonds? For the same level of risk, you're getting more return. And it just goes to show you how great that asset class
It's
really
been,
has been and
yeah.
continues to be. And now that I'm saying it, who knows? But
I know.
but it has really been a tremendous asset class. And then you keep going up the line here, and you see this one natural resources kind of off the line. And
Right.
we would have suspected that natural resources. We want to keep natural resources in your portfolio because of its negative, negatively related to how the U.S. market works, and it always
Yep.
is just like this year, just like in 2022, same thing where natural resources really performed when the market was not. But you can see it's not as
Yep.
efficient. You almost want to say, well, gee, if you're going to take on that level of risk, you would prefer to take small cap
Yep.
stocks. But we
Yep.
have natural resources there for a reason because of the
Well,
diversifying effect.
also this chart will grade it's only piece of the story. The other piece of the story, which we're not showing here, are is the interplay of the returns of these asset classes over time with each other. In other words, the correlation.
I love this chart because Steve just took the raw data and he plugged it into, believe it or not, AI, and
AI.
it just interpreted the data just as it is. We
Yep.
took reams of data, and that's beautiful.
It is. It's a good chart. It really is. AI is helpful. You could have a much greater potential downside than its potential upside, and you don't want to be in investments like that, by the way. And most really, if you have a concentrated stock position, you're really subject to event risk. And when you see some of these examples, you'll see what we mean about that, by the way. So here's one. This affected emerging markets funds for one. And I remember we were still with TD Ameritrade at the time, and they had this banner when every time you logged on, it said Russian stocks, if you hold any, are illiquid. You couldn't even trade them. And so any emerging markets funds that had Russian stocks, they were in big trouble.
So
Um,
this is the point. Yeah, earlier I said something about event risk is not a breakdown of the economy, but it,
right.
it it could be a breakdown of the actual economic engine of a particular asset or a particular country or that
Yep.
type of thing. And so it destroys value overnight, and oftentimes value that is irreversible. So
Yep.
it's the problem with event risk is that it can be just it can impair the overall true value of a company. So you won't see, or a country or whatever, you won't see that B shape.
Another one is suppose you have an unstable political system and they decide to nationalize all the industry. Goodbye, goodbye, stockholders. So here's another one. As the Lehman Brothers bankruptcy and also the Bear Stearns bankruptcy also, I think happened in the same year, if I remember. And this was sort of evidence of the contagion that was starting to spread, by the way, through the economy because of the subprime loans. Um, and by the way, great movie to watch on that, of course, is The Big Short, right?
Mm.
And it's fairly accurate regarding what actually happened too. And it started to trickle through the system because a lot of these banks and financial institutions were sort of connected together financially. And so it's almost like when you knock one domino over, they all fall over. And actually, I think they sort of have a demonstration of that. They what they did is they took these loans, mortgage-backed loans, and split them up into tranches of value. So one tranche you got a certain payment, another tranche you got another payment, and as you went up the scale of the tranches, the ones at the top were very risky, and he started to fail. And I can't really explain all the details here, but it's very interesting to study what actually happened there. This was a big one. It happened just 3 years ago. I think, and I read the details on this, and I don't fully record them, but I remember recall them. But I think the Federal Reserve had to step in because there was a potential contagion here that could spread, and they were betting, I think, on treasuries, and so they were starting to have a big problem. They were losing liquidity, and so effectively, this bank failed. So. Of course, the Boeing with the 737 MAX crash, there was a software issue in the system in those planes, and that really damaged Boeing. Could have knocked them out of business totally, lawsuits and everything else. But it really hurt the stock for many years. Actually, Boeing. I think the stock they're recovering now, but it really hurt them, and it could have been worse. It could have put them out of business. By the way, for all we know. Yeah, so those are some good examples.
And another one actually that people might recall is Microsoft. In
Yeah,
2000, Microsoft had an antitrust lawsuit. So some of these things you might know if you actually sit in the boardroom that is coming, but
right.
oftentimes not. Microsoft went down, I want to say something like 68%. It stayed down for many, many years. I don't
For
think it came up
years.
to like maybe, somewhere. I think it started coming up in 2007 and then it went down again and it didn't really kind of get its footing for many years after that.
That's a good point. And by the way, I have a list of another 8 or 10, which we didn't even include in here
Yeah.
because it would just be too much. But I have a whole series of them. I can provide it to anybody that are interested of some of these events that have occurred. And so this shows you the sensitivity of some types of investments against event risk. Single stock, concentrated stock positions, no question. Those are very sensitive to event risk. Boeing's an example, Microsoft, your example. Employer stocks, RSUs. Once your RSUs mature and you can actually sell them, I recommend you sell them right away. Don't keep them. Plus, you've already paid the tax on it for the most part. They withhold some of them to pay the income tax. Don't ever become over allocated to your employer's stock because you're sensitive to that company's performance in two levels. One, their stock, and secondly, your employment. So you don't want that combined together. I mean, high yield credit, I've never been a big fan of high yield bonds, which is a euphemism for junk bonds or bonds with low credit ratings. And the default rate for high yield bonds can be 6 to 8%. It has been historically. Um, Leverage strategies for example, let's use an example, you have a stock position at a brokerage firm and you decide to use margin to, buy more stock. And now suddenly the market drops and you get a margin call. And guess what? Now you have to liquidate some of your position to pay the margin call, right? And then what happens is now suddenly you got a big capital gain potentially. So now you got a tax issue. And so it starts to snowball from there, by the way. So I've seen it happen to people. Um, it's low for broadly based, well-diversified ETFs, index funds and that type of thing, and also low for laddered investment grade bonds in general. And we sort of mentioned this too, right? People said, "Oh, this," you remember the Nifty 50. People may not remember that. It was back from the 70s. The 50 stocks you couldn't go wrong on. One of them was Kodak, by the way. And where's Kodak now, right?
Mm.
They were subject to event risk. What happened? Digital cameras, you know.
I worked for Sears, and so Sears got me.
Sears. I know. I'm sad about Sears, actually.
Worked for
I used
them.
to love their tool. I used to love their tool store, I'd
Yep,
go in there and just stare at the tools and want all of them. Being a big dumb male. Yeah, so
they were my first lesson in investing.
in investing.
Yeah,
Yeah.
don't concentrate your holdings.
Yeah. Well, look, they sold off their pieces. They sold off Craftsman tools to, I think, Stanley, try to save themselves, and it didn't work, sadly. So. Also, we mentioned concentrated stock position, and we did a rather lengthy video on this about 8 or 9 months ago. It's on our YouTube channel, but this is just a very quick summary. I think we said that probably this says 10 to 20%, but we think 10% is of your portfolio in one stock is a concentrated stock position. And it can really put your future goals at risk if you have that much of one stock. Look, you can hit a home run. Some people have with Amazon or Apple, but there's the problem is you don't hear about the stories of the people who really lost big. For example, and General Electric was another one, by the way. You
Mhm.
know,
Yeah, that was
yeah, and
my guy that he was an executive in all his own stock gifts, PSUs, RSUs, all of that. And didn't want to sell
yeah,
because he had a capital gain problem. But then he didn't
right.
have a capital gain problem anymore.
It went away. Yeah, exactly. The problem with General Electric was that people didn't realize they were a finance company. They weren't an industrial company because most of their pieces of their company that were in industries like manufacturing, I think jet engines, turbine engines and other areas weren't really profitable. It was all from their finance sector, most of it.
They lost
They weren't.
core competency.
Yeah, you're right. Yep. So. Yeah, and so you want to be, if you do want to hold individual stocks, you should have at least 40, 50 different stocks. And you need to monitor them. It's not as if you have an index fund. You want to keep track of them. So, and so we talk about this often about what we call idiosyncratic risk, and that's risk that's unique to a particular investment. There's business risk. A lot of these we already covered. I don't know if we need to go over them
No.
in that any detail. But this is the risk you experience with a single investment. And by the way, the important point here is you don't earn extra return by taking these risks. Okay. The only real free lunch in investing is to be diversified. And was it William F. Sharper said that, or was it Merton, I think, was it? Who said it originally?
Uh, Markowitz.
Okay, Markowitz. Yeah, okay. Yep.
S-
Okay.
so yeah, I mean, it's all about having a disciplined strategy, right?
Yep.
That's really key. We, first of all, making sure that you understand what you want to be invested in. Hopefully, it's investment grade. Making sure
Right.
that you have, and I always talk a lot about the now, sooner, soon, later buckets to people when they need to get a sense
Yep.
of what about my cash needs. I mean, when we diversify in asset allocation, we're not always necessarily saying to you, this is your now bucket, this is your soon bucket, but we're cognizant of it. We know
Yep.
where the sources of income are going to come from. And so even if the market misbehaves for a period of time, we know how we're going to generate the cash for you. And that's why we
Yep.
want to talk to you about that. Now,
Yep.
in terms of rebalancing, I do want to say that there's usually a couple strategies that we would take in a normalized kind of contained escalation, which is kind of where we are right now. We're going
Right.
to balance. We're going to review the drifts, and we're going to rebalance if the bands breach the drift mark, and we rebalance on a trigger point, and so that's fine. If it goes on for a long period of time, we may stagger the rebalancing, and Steve and I might talk about it and say, you know what, it's calling for rebalancing, but maybe we're going to hold off and just make sure that we have our now buckets filled. Um,
Yep.
and of course, it becomes
Yeah.
clear then there's kind of how do we want to raise liquidity and so forth, but we're still not saying, okay, we're going to dump this strategy and go to
No.
something else. We have a strategy that was built specifically for these types of, and you as
Yep.
people are seeing, they see, okay, this time it's the Iran, last time it was Israel, last time it was the pandemic.
Right.
I mean, these things
Right.
do
We
happen.
didn't even bring that one up. The pandemic was one. That's a good one too.
Um,
Yep.
but even though we talk about investments like, oh, this is something new, there's always something crazy that we haven't thought about. We never
That's
really
for sure.
know
Yeah.
what's going to happen. And so by having
Yeah.
this kind of all-weather strategy, you're locked. into something that should sustain you regardless of how severe the environment gets.
And I want to mention regarding get back to rebalancing that we try to do it carefully. Like when we look at it, I do a lot of it. I look at it, I say, gee, it's going to generate a lot of capital gains. Doesn't make sense doing that right now. So we do look at it from that standpoint too. We know how important rebalancing is, but we don't want to generate a lot of big tax events for you if we can avoid it as well. We try to avoid that too. So okay. So I think we've always covered this. Um,
Yeah.
how that you're so well diversified. We repeat ourselves, several times in this video on this point. So I don't know if we need to really go over this in detail, Laura, unless you want to add something.
No, no, I think we have covered it. Um,
Yeah, I think so too.
I think it is important that we had a conversation about event risk and what's going on. Um,
Yes.
Please, if you want to talk about this at all, this piece or any aspect of your portfolio, we're happy to talk about it. But, I think any client that's been with us for any period of time knows how truly diversified. I mean, when people say diversified, I always want to ask them, but are you diversified as much as we're diversified? Because
Right.
we have really spent many, many years developing a diversified model that
Yep.
will protect you
Yep. Definitely.
and still generate a decent return.
Yeah, that's for sure.
Yeah,
Yep.
yeah. So again, thank you for listening. And if you have any questions, please feel free to give us a call.